At 5:23 on a Thursday morning, in a quiet subdivision outside of Charlotte, North Carolina, Gerald sat at his kitchen counter with the glow of a single pendant light casting a pale circle over his laptop screen. The brokerage statement was already open, the cursor blinking beside a transfer button he had been staring at for 11 minutes. His traditional IRA showed a balance of $487,200, and the Roth IRA below it held just $41,600 from a conversion he had done 2 years ago. The coffee beside him had gone cold without him noticing, and the only sound in the house was the low hum of the refrigerator behind him. He wanted to move another $65,000 over before the end of the year, but something in the numbers felt off in a way he could not name. His index finger hovered above the trackpad without pressing down, the way a person pauses at the edge of a diving board when the water suddenly looks deeper than expected. He had read 3 articles that week, telling him Roth conversions were the smartest move a retiree could make, and each one made it sound simple. But the spreadsheet he had built to estimate his tax bill kept producing a number that made his chest tighten. The problem was not whether to convert. It was whether converting right now, this year, in this amount, would quietly cost him more than it saved. Gerald is not unusual. The majority of retirees who attempt a Roth conversion do so with incomplete information, and the mistake has a name most of them never encounter until the tax bill arrives. It is called a tax bracket overshoot, and it can turn a smart strategy into an expensive one in a single December afternoon. 5 checkpoints. That is what separates a Roth conversion that builds your future from one that damages it. And each one is something you can verify before you move a single dollar. By the end of this, you'll understand exactly how a Roth conversion interacts with your tax brackets, your Medicare premiums, and your Social Security check all at once. You'll see why the size of your conversion matters more than whether you convert at all. You'll learn the 5 specific things to check before you initiate any transfer in 2026. And you'll have a clear method to calculate the right number for your situation, rather than guessing based on generic advice. You do not need a finance degree to follow this. You need 15 minutes of honest attention and a willingness to look at your own numbers. Retirement changes the rules of income in a way that most people do not fully appreciate until they are already living inside the new system. During your working years, income arrived from one direction, your paycheck, and taxes were handled before the money reached your bank account. In retirement, income can flow from 4 or 5 different accounts, each one taxed by completely different rules, and the combination of those flows determines what you actually owe. If you recently retired or you are within a few years of doing so, this shift applies directly to your financial life starting now. The 3 account types you need to understand are traditional tax-deferred accounts, Roth accounts, and taxable brokerage accounts. And the relationship between them is the foundation of every decision covered here. Think of your retirement accounts the way a chef thinks about a recipe with 3 main ingredients. Each ingredient has its own character, its own reaction to heat, and its own ideal moment to be added. Use them in the wrong order or in the wrong proportion, and the result is a dish nobody wants to eat, even though every ingredient is perfectly good on its own. That recipe, the order, the timing, the proportion, is what this entire conversation is about. A traditional IRA or traditional 401k holds money that was contributed before taxes were paid on it, which means every dollar inside has never been touched by the IRS. When you withdraw from these accounts, each dollar is taxed as ordinary income at whatever your federal tax bracket happens to be that year. If you withdraw $50,000 in a year when your bracket is 22%, you owe roughly $11,000 in federal tax on that withdrawal alone. These accounts also come with required minimum distributions starting at age 73, which means the IRS will eventually force you to take money out whether you need it or not. The size of your RMD is based on your account balance, so a large traditional IRA creates a large mandatory withdrawal that pushes your income higher every year. A Roth IRA or Roth 401k is the mirror image. Contributions were made with money that was already taxed, so every dollar inside, including all the growth, comes out completely tax-free in retirement as long as the account has been open for at least 5 years. Withdrawals from a Roth do not count as income on your tax return, which means they do not push you into a higher bracket, do not trigger Medicare surcharges, and do not cause your Social Security to become taxable. The difference between pulling $40,000 from a traditional IRA and pulling $40,000 from a Roth IRA is invisible on your bank statement, but enormous on your tax return. This is why so many people want to convert. They want to move money from the tax side to the tax-free side. A taxable brokerage account sits outside the retirement system entirely, and withdrawals are taxed under capital gains rules rather than ordinary income rules. Long-term capital gains rates are lower than ordinary income rates for most retirees, usually 0% or 15% depending on your total income. Understanding how this third ingredient fits into your withdrawal recipe is what lets you control the overall flavor of your tax year. With these three types clear in your mind, you can see why the order in which you pull from them changes everything. Most retirees hear about Roth conversions and immediately assume that converting as much as possible, as fast as possible, is the optimal move. The logic feels airtight. Taxes are likely to go up, the money grows tax-free after conversion, and you eliminate RMDs on whatever you convert. This intuition is not wrong in principle, but it is dangerously incomplete. The size and timing of a conversion matter at least as much as the decision to convert at all. Here's the first thing that goes wrong. Every dollar you convert from a traditional IRA to a Roth IRA is added to your taxable income in the year you convert, and your tax brackets fill up from the bottom like water rising in a container. If your other income already places you in the 12% bracket and you convert $60,000, part of that conversion may be taxed at 12%, but a significant portion may spill over into the 22% bracket. That jump from 12 to 22% is not a gentle slope. It is an 83% increase in the rate applied to each additional dollar. A retiree who converts $15,000 too much in a single year can pay $1,500 or more in unnecessary federal tax on that overshoot alone. The second invisible consequence involves Medicare, and this is where many retirees are caught completely off guard. Medicare Part B and Part D premiums are adjusted based on your modified adjusted gross income from 2 years prior, through a surcharge system called IRMAA, Income-Related Monthly Adjustment Amount. If your Roth conversion in 2026 pushes your income above $206,000 as a married couple, you may pay over $400 per month per person for Medicare Part B in 2028 instead of the standard amount near $185. That is an additional cost of more than $5,160 per year that many conversion calculators never include. A conversion that looked brilliant on a spreadsheet can quietly add thousands in Medicare surcharges that eat into the very savings it was supposed to create. The third consequence is the taxation of your Social Security benefits, and this one compounds the other two in a way that feels almost unfair. If your combined income, which includes half of your Social Security plus all other taxable income, including Roth conversions, exceeds $44,000 as a married couple, up to 85% of your Social Security becomes taxable as ordinary income. Run the numbers on your own withdrawals and conversions from last year, and you may find this cascade has already started happening to your benefit check. A Roth conversion that adds $40,000 to your income can cause an additional $34,000 of Social Security to become taxable, which means you are effectively being taxed on $74,000 of income from a $40,000 conversion. Gerald ran those numbers at his kitchen counter that Thursday morning and discovered that the $65,000 conversion he was about to execute would have pushed him past two thresholds simultaneously: the 22% bracket boundary and the first IRMAA tier. The total additional cost would have been roughly $11,370 across federal taxes and Medicare premiums over the following 2 years. What felt like a straightforward financial move was actually a quiet trap. The dominoes keep falling, and they fall in directions most retirees never think to look. The real cost of a poorly sized Roth conversion is not a single year of higher taxes. It is the cumulative effect of repeated overshoots compounded across 15 or 20 years of retirement. If a retiree converts $15,000 more than optimal every year for a decade, the excess taxes and Medicare surcharges alone can exceed $38,000 in today's dollars. The math on Roth conversions is not about whether converting is good. It is about finding the precise amount that fills your low brackets without spilling into the expensive ones. That number is different for every person, every year, and it requires actual calculation rather than a rule of thumb. There is a window in retirement that financial planners sometimes call the golden window, and it opens the day your paycheck stops and closes the year you turn 73 and RMDs begin. During these years, your taxable income is often the lowest it will ever be because you are no longer earning a salary, but the IRS has not yet started forcing withdrawals from your traditional accounts. This is the period when your lower tax brackets sit partially empty, waiting to be filled on your terms. Most retirees either ignore this window entirely and let those cheap brackets go unused, or they overshoot the window by converting too aggressively and paying higher rates than necessary. The goal is to fill the low-cost space methodically, year by year, like adding the right amount of seasoning each time, rather than dumping the entire jar in at once. The counterintuitive strategy is to convert just enough each year to fill your current tax bracket to the top without crossing into the next one, and to do this every single year during the golden window. If you are married filing jointly and your taxable income from Social Security and other sources is $52,000, you have room to convert approximately $42,050 before you cross from the 12% bracket into the 22% bracket in 2026. That conversion costs you roughly $5,046 in federal tax today, but it removes $42,050 from future RMDs where it might be taxed at 22 or even 24%. The math favors this approach precisely because it is disciplined and precise, not because it is dramatic or aggressive. Each dollar you convert to a Roth disappears from your traditional IRA balance permanently, which means your future RMDs at age 73 are calculated on a smaller base. A $42,000 conversion today might reduce your annual RMD 10 years from now by $1,800 or more. And that $1,800 stays tax-free every single year for the rest of your life. Over 20 years of retirement, that single conversion could save you over $36,000 in taxes that would have been owed on those forced distributions. The compounding of tax-free growth inside the Roth makes the real benefit even larger than the immediate tax savings suggest. The recipe is precision. You are not trying to convert everything. You are trying to convert exactly the right amount at the lowest possible cost every year for as many years as the window stays open. Ask yourself which tax bracket you are actually sitting in right now and how much room is left before you cross into the next one, because that empty space is the most valuable resource in your retirement plan this year. The right Roth conversion is measured in basis points, not bold gestures. And the difference between getting it right and getting it almost right is tens of thousands of dollars over a retirement. Eleanor is 64 years old, recently retired from a nursing management position in suburban Minneapolis, and her financial picture looks like this: $392,000 in a traditional 401k that she rolled into a traditional IRA, $28,400 in a Roth IRA from small contributions over the years, and $67,500 in a taxable brokerage account. Her Social Security benefit, which she plans to start at 66, will be $2,340 per month. Her annual spending is approximately $54,200, including property taxes, insurance, groceries, travel, and a monthly payment on a car she financed 2 years ago. Eleanor decides to take all $54,200 from her traditional IRA each year because the balance is large and the Roth feels too small to touch. That withdrawal, combined with her Social Security income of $28,080 annually, places her combined income well above the $44,000 threshold for Social Security taxation, meaning roughly $23,800 of her Social Security becomes taxable. Her effective federal tax bill lands near $8,740 for the year, and she has done nothing to reduce her future RMDs, which will start in 9 years on a balance that keeps growing. If your situation looks anything like hers, a large traditional balance and a habit of pulling from it first, you are likely paying more in taxes than you need to be. Daniel is also 64, retired from an operations role in a manufacturing company near Raleigh, and his numbers are remarkably similar: $378,000 in a traditional IRA, $52,100 in a Roth IRA, and $43,800 in a taxable brokerage account. His Social Security at 66 will be $2,280 per month, and his annual expenses are $53,600. On paper, Daniel and Eleanor are nearly identical in total wealth and spending needs. Daniel takes a different approach to covering his $53,600. He first lets his Social Security cover $27,360 of it, leaving a gap of $26,240. He pulls $14,000 from his taxable brokerage account, where most of the gains qualify for the 0% long-term capital gains rate because his income is still low. He takes the remaining $12,240 from his traditional IRA, which keeps his total taxable income low enough that less than $9,400 of his Social Security becomes taxable. His federal tax bill for the year is approximately $3,180, a savings of $5,560 compared to Eleanor's approach with nearly identical resources. Then Daniel adds one more move. He converts $31,840 from his traditional IRA to his Roth, filling his 12% bracket almost exactly to the ceiling without crossing into the 22% bracket, and pays just $3,821 in additional tax on that conversion. That $31,840 conversion cost Daniel $3,821 today, but removes those dollars permanently from his traditional IRA, which means his RMD at 73 will be calculated on a smaller balance. The math over the next 15 years shows that this single year's conversion saves him approximately $7,600 in future taxes and Medicare-related costs, when those dollars would have come out at higher rates. If you still have room in your bracket this year and your income is temporarily low, this is your window, and it will not stay open once RMDs begin or if tax rates rise. Over a 15-year retirement, the cumulative difference between Eleanor's approach and Daniel's approach, assuming Daniel repeats his strategy each year during the golden window, exceeds $87,000 in total tax savings. That is not hypothetical growth or projected market returns. It is money that stays in Daniel's accounts instead of going to the IRS. Same wealth, same expenses, different recipe. And the outcome is a fundamentally different retirement. The first thing to do is pull up your most recent tax return and identify your current filing status and taxable income line by line so you know exactly where you stand inside the bracket system. If you filed jointly and your taxable income was $89,450 or below in 2025, you were in the 12% bracket, and that ceiling is the number you need to memorize for planning purposes. You can find your bracket boundaries on the IRS website or on the first page of the 1040 instructions. Knowing where you are is not optional. It is the foundation of every move that follows. The second step is to map every source of income you expect in 2026. Write down your Social Security benefit, any pension, any part-time work, rental income, interest, dividends, and any other money that will appear on your tax return. Add half your Social Security to all the other amounts, because that is how the IRS calculates your combined income for determining Social Security taxation. Now subtract your standard deduction for 2026. For a married couple over 65, that number is likely near $33,000. And you have your approximate taxable income before any IRA withdrawals or conversions. The gap between that number and your actual spending needs is what you need to fill from your accounts. The third step is to fill the gap strategically by pulling first from your taxable brokerage account, where gains may be taxed at 0%, then from your traditional IRA only as needed to cover the remaining expenses, and finally looking at how much room is left in your current tax bracket for a Roth conversion. If your taxable income after withdrawals is $61,000 and the top of the 12% bracket is $94,050, you have approximately $33,050 of conversion space available at the lowest rate. That is the amount you can convert without triggering a bracket jump, without crossing an IRMAA threshold, and without causing additional Social Security taxation. Use that space like the final seasoning in a dish, precisely measured, not guessed. The fourth step is to revisit this calculation in October or November of each year, because your actual income may differ from your January estimate in ways that change the optimal conversion amount. Your next move is the one that matters most. Before this year ends, have this conversation with a CPA or fee-only financial planner who can verify your numbers and catch anything you might have missed. A single professional review can cost a few $100s and save you thousands in taxes over the following decade. Do not rely on a conversion calculator you found online without confirming its assumptions match your actual situation. Gerald eventually closed his laptop that Thursday morning without pressing the transfer button, and he spent the next week recalculating his bracket space, his Medicare thresholds, and his Social Security taxation line by line. When he finally executed a Roth conversion in late October, it was for $34,200 instead of $65,000, a number that fit precisely inside his 12% bracket with enough margin to stay below the first IRMAA tier. The money he did not convert stayed in his traditional IRA, where it would be available for another measured conversion the following year. He had traded the anxiety of a bold move for the quiet confidence of an accurate one, and the difference over the next 12 years of his retirement was projected to save him over $52,600 in combined federal taxes and Medicare surcharges. The recipe for a Roth conversion is not about speed or size. It is about proportion, temperature, and timing. The same way a dish that looks simple on a plate often required the most careful preparation behind the scenes. Your retirement is not a single meal, but a long season of cooking, and each year offers you a fresh chance to adjust the ingredients based on what the tax code and your income actually look like. The quiet truth is that the retirees who keep the most of their money are not the ones who made the boldest moves. They are the ones who measured twice before every single cut. Drop a comment below with the one checkpoint from these 5 that surprised you the most, or the one you realized you had been skipping. If this changed how you think about your own Roth conversion timing, a like helps this reach someone else who is sitting at their own kitchen counter right now, trying to decide whether to press that button.